back. This is Stock Rock. Today I'm going to give you a little bit of my input on the earnings for Tesla and Netflix. So Tesla came in with revenue of 28.1 billion, up 12% year over year. Vehicle deliveries came in pretty strong because of the tax credit, up 7% year over year, which is great. But what are we going to expect for next quarter? It's a little concerning. So that's my concern. The net income was very weak, down 37% year over year. And especially if we have the tax credit ending, you would expect a lot of the higher end vehicles to be selling. And going through the earnings, you see a lot of the bulk of the purchases being either a Model 3 or a Model Y. So the higher end vehicles are not even being purchased. The decline in Cybertruck and Model S, Model X purchases were down significantly, which is very concerning. And we have gross margins contracting. For automotive and energy, gross margins were around 18% in quarter three, down from 19.8% last year. Operating margin was around 5.8% in quarter three 2025 compared to 10.8% in quarter three 2024. So a margin compression of over 5 percentage points, which is very high. There is a lot of higher tariff costs, trade headwinds. Tariff impacted the business over $400 million, declining regulatory and emissions credit revenue, negative 44% for credits year over year, and their elevated investment in AI and robotics. That could be a highlight for the business, but at the moment, it's not. And taking in 1.3 billion in revenue or net income and being valued at 1.3 trillion is very concerning. So if the market is going to crash, Tesla is going to crash even harder. Even though they achieve strong revenue growth and record delivery volumes, the sharp drop in profit and margin compression highlight that scaling still carries significant cost risk. Netflix came in with revenue of 11.51 billion, 17% year-over-year growth, which is great. Net income came in at single digits, 2.55 billion, up 8% year-over-year. Operating income, 3.25 billion, about 12% year-over-year growth. The operating margin in quarter three was affected and was at 28%, below their guidance, which is why the stock was down after hours. But I think the expenses for the business was a little concerning because without the $619 million Brazilian tax dispute expense, margins would have been in line with 31.5% or higher for the guidance. And that would have brought net income up. So maybe it wouldn't have been single digits, but that definitely did hit the company, and there is one-offs and something to watch. But a little concerning for me was the cost for sales and marketing went up 22% year over year, which definitely hit those margins in the net income, up from 643 million to almost 800 million. Free cash flow for the quarter, 2.66 billion, up from 2.99. This is about a 21% year over year. Despite the strong growth metrics, Netflix shares dropped 6% in after hours and dropped 10% today. So Netflix did deliver solid top line growth, improved profits, and operating income, strong free cash flow, showing a healthy growth margin profile. Still, even with these good metrics, the market was muted because of the tax surprise and the margin expectations not fully being met. So what does this mean for big tech? Growth matters, but profitability and margins are super critical right now because all this investing in AI. Tesla's case shows revenue growth isn't enough if margins erode significantly. They want execution clarity, transparency about one-time items or surprises. They do matter, such as Netflix case. Strong metrics were overshadowed by a tax expense, but I don't necessarily think the tax expense is the only reason why. I think it could have a little bit to do as the stock has been on quite a run already this year, and the cost of doing business is increasing, and they're showing it in their expenses. But for many big tech players with significant investments in AI infrastructure, new business lines, investors will be evaluating how fast they grow, but just efficiency on how they scale and the return on those investments. Any non-operational or regulatory surprises can cause an outsized stock reaction. Firms that show both growth and improving margins will be better positioned in this cycle than those relying primarily on revenue growth. So in short, look out for these margins for these big tech companies. See how the AI investments are really playing out in their business and how it's really driving or growing the business. Thanks for watching. Stock Pro. Peace.